Good morning. I call this hearing to order. Without objection, the chair is authorized to declare recess at any time. I would like to begin by noting some important requirements. Standing House and committee rules will continue to apply during hybrid proceedings. All members are reminded that they are expected to adhere to these rules, including the quorum. House regulations require members to be visible through a video connection throughout the proceedings, so please keep your cameras on. Also, remember to remain muted until you are recognized to minimize background noise. In the event a member encounters technical issues that prevent them from being recognized for their questioning, I will move to the next available member of the same party, and I will recognize that member at the next appropriate time slot, provided they have returned to the proceeding. So our nation's 30 million small businesses come in all shapes and sizes across various industries. But regardless of the product they sell or the number of employees on their payroll, the ability to access capital is crucial to their success. Unfortunately, our committee frequently hears from entrepreneurs about the struggle to obtain an affordable loan on reasonable, non-predatory terms. The data supports these anecdotes. The Federal Reserve published its 2022 Small Business Credit Survey that found that almost 60% of small employer firms reported not having their capital needs met. To fill this gap, the Small Business Administration offers a range of lending programs to serve businesses that cannot obtain credit elsewhere. These initiatives are administered by the Office of Capital Access, also known as OCA. OCA carries a loan portfolio of over $1 trillion and oversees traditional SBA initiatives and pandemic relief programs. Their work is fundamental to SBA's mission of helping Americans start, build, and grow small businesses. Today, I would like to hear from our witness about what is working well at the office and the challenges they face. This is especially important in the wake of an unprecedented increase in demand for SBA traditional lending offerings. For example, in FY 2022, the 504 loan program experienced record high demand and reached the authorized lending limit of $7.5 billion, causing the program to pause lending in early September. This increased demand has persisted in FY 2022, and the program was on pace to be forced to shut down in July before a funding level adjustment was enacted. We are grateful for the bipartisan and bicameral cooperation between our committee and the Appropriations Committee to secure that funding adjustment and keep the 504 program open for lending this fiscal year. However, we must continue finding ways that the agency and Congress can ensure that SBA programs are equipped to keep pace with demand from small businesses. I would also like to discuss the steps OCA is taking to help create a more equitable small business economy. SBA data shows that the number of 7A loans of $150,000 or less declined by almost 52% since FY 2016, and that loans of $50,000 or less fell nearly 58% during the same period. Administrator Guzman stressed the importance of small dollar loans when she testified before the committee last month. So I would like to hear more about OCA's work to ensure that all small firms have access to the capital they need to thrive. And with the recent news of the COVID EIDL program closure, this is a very timely hearing for us to discuss the OCA administration of pandemic relief initiatives. On Thursday, May 5th, the SBA announced that it will not longer accept applications for loan modifications, reconsiderations, and appeal due to exhaustion of program funding. Today, I hope we can provide answers to the many members and businesses calling us who are awaiting application decisions. Small employers are leading the way in our pandemic recovery. Since 2021, entrepreneurs have started a record number of small businesses, and small firms have created jobs at a historic pace. However, their continued success is contingent on their ability to access capital. So I look forward to discussing the Office of Capital Access and what Congress can do to help the office better serve American small businesses. I would now like to yield to the ranking member, Mr. Lukemeyer, for his opening statement.
Thank you, Madam Chair, and thank you for holding this hearing today with Mr. Kelly. Prior to the COVID-19, the nation's small businesses and our economy in general were operating at full speed. The low tax environment enabled by the 2017 Tax Cuts and Jobs Act and the smart regulatory environment we were allowing small businesses to grow, compete, and create jobs across America. Unfortunately, the capacity restrictions and shutdown measures of COVID-19 forced small businesses to think and operate differently. With limited foot traffic and minimal dollars coming through their doors, small businesses were left without any options. They turned to the federal government and the country's COVID-19 relief measures, and in particular, the Paycheck Protection Program. Overnight, millions of small businesses became aware of the resources and tools available to them at the Small Business Administration. Additionally, thousands of lenders raced to assist them. When I'm home, I sit and I talk to small businesses, and I often hear that the PPP saved their businesses. While the nation continues to recover, our work is not over. Agencies and small and program offices that ran and played a significant role with these relief measures must continue to talk and work with members of Congress. That is why I'm glad to have Mr. Kelly before us this morning. In addition to helping administer the PPP, the Office of Capital Access has also, under the Biden administration, taken the reins of the fraud-plagued Economic Injury Disaster Loan Program, also known as EIDL, and the office was involved with the unconstitutional and underfunded Restaurant Revitalization Fund, where Congress prioritized some restaurant owners over others. To say the least, we have a lot of questions for this office and how they performed the last 2 years. For example, the Biden administration continues to defer EIDL payments for small business owners. These loans have a maturity of 30 years, now have a deferment payment of over 30 months. That means the American public, Congress, and law enforcement won't know how the program was performed, nor will they see the true extent of fraud until payments are required. The SBA's Inspector General has already flagged this program for potentially $80 to $90 billion in fraudulent loan activity. And yet, this office, the administrator, and Biden administration continues to defer payments. I'd like to remind everyone the EIDL program was a direct loan and grant program where the SBA qualified small businesses and dispersed funds directly. SBA Inspector General has documented that identity theft was rampant in this program. In fact, follow-up answers to this committee by the administrator indicate that the number of flagged applications for identity theft has swelled to over 1 million. This means that criminals got through the SBA's open door and entered the program illegally. Additionally, and just yesterday, the SBA Inspector General found its independent auditors report that the SBA Direct Disaster Loan Program continues to be overwhelmed with issues. The report indicates that the program had gross improper payments and an unknown payments rate exceeding 10%, which is higher than the statutory amount. Beyond these very large concerns, this office also administers all of the SBA's government-guaranteed lending programs. These programs, which are delivered to small businesses through efficient and responsible public-private partnerships with lenders, assist small businesses when traditional and conventional capital is not available. Who is accessing these programs? Who is lending within these programs? How is SBA overseeing these lenders? These are major questions that need to be addressed. With all the new interest and focus on SBA, this office's list of statutory required duties is long. We have a lot of work that is mandated in law. New and extraneous projects must not divert attention away from what they must accomplish. COVID programs must be concluded effectively, efficiently, and responsibly. Traditional programs need to be calibrated and staffed appropriately. Unfettered policymaking and decision-making will not stand. However, I'm glad the SBA will be at least here today to testify, because I can't say the same about Secretary Yellen. Even though she is charged with onboarding new PPP lenders, and despite being statutorily required to testify, she continues to ignore this committee and American small business. As I said earlier, our work is not done. With soaring inflation, the economic environment for small business is not great. However, despite these challenges, small business owners have the resiliency to drive our nation forward. With that, Madam Chair, I look forward to today's conversation and the many conversations before us regarding SBA's Office of Capital Access, and I yield back.
Thank you, Mr. Lukemeyer. The gentleman yields back. With that, I will now introduce our sole witness today, Mr. Patrick Kelly. Mr. Kelly is currently serving as the Associate Administrator of the Small Business Administration Office of Capital Access. This is Mr. Kelly's second tour of duty at SBA. He previously served as Deputy Chief of Staff, Deputy Associate Administrator, and Senior Advisor at SBA during the Obama administration. Prior to his current service at SBA, he was an executive with an active lender in the 7A program. His blend of public and private sector experience has been invaluable as he led the SBA efforts with the third round of PPP funding and now in the critical forgiveness stage. Mr. Kelly is a graduate of Colgate University and Boston College Law School. Welcome, Mr. Kelly. You're now recognized for 5 minutes.
Thank you. Good morning to the committee. Good morning, Chairwoman Velasquez, Ranking Member Lukenmeyer. On behalf of Administrator Isabel Guzman, it's my pleasure to be here. As Chairwoman noted in my bio, my name is Patrick Kelly. I am the Associate Administrator for the Office of Capital Access. Since last March 2021, so just over a year, I've had the opportunity to serve alongside some of the greatest civil servants that this country has put forward. For the last 24 months, civil servants in the Office of Capital Access and across Office of Disaster Assistance have put forward over $1 trillion of lending that, as was noted by the ranking member's remarks, is greatly appreciated in all over the country by small businesses. They are dedicated, outstanding, and it's my privilege to work with them. Over the last 12-plus months, our office has been responsible for the PPP program, Round 3, which originated another 6.1 million, roughly, PPP loans in Phase 3. The COVID EIDL program we took over in July, and that has led to an additional 300,000, more or less, loans made in 2021 until today. Each of those programs is, hundreds of billions of dollars. In addition, as was noted, had the pleasure of administering the Restaurant Revitalization Program on behalf of Administrator Guzman, where we put out $28.6 billion to 101,000 restaurant-related entities, more or less in 45 days from the bill's passing. That particular program was a opportunity to work with grant recipients who are near and dear to all of us. You cannot tell the story of your life without a restaurant or related entity, and certainly that's true for me. With respect to the core programs, as Chairwoman Velasquez noted, the lending in our core programs in fiscal year 2021 continued at a pace. In addition to the 504 numbers that were cited, the 7A program also distributed $35 billion to roughly 50,000 small businesses. So those particular programs will continue to be of use as we move forward for small businesses, most especially to attack the problems that Chairwoman Velasquez spoke about earlier with respect to accessing small dollar loans, which continues to be a persistent challenge. And we have recently begun to address that by building off of one of, I think, the bipartisan successes of the PPP program. As you all know, in Round 3, community financial institutions were given an exclusivity period at the outset of that program in order to onboard those parts of the community that felt they were underbanked in Rounds 1 and 2. That led to 600 community financial institutions making roughly $30 billion of additional PPP loans, more or less, over that Phase 3. As was mentioned, we have 5,000 lenders who participated in the PPP program. They span financial technology companies, which historically are not eligible to lend in the program, community financial institutions, which historically have been limited to the Community Advantage Program, and obviously banks and credit unions. In a typical 7A year, about 1,900 banks make at least one loan, and over a 5-year period, it's roughly 4,000. So one of the tasks that Administrator Guzman has put our office on is ensuring that we build off of the momentum of participation by simplifying the products on behalf of our lending intermediaries so that they might leverage digital tools and take advantage of the secondary market tool, which is an excellent resource for SBA 7A lenders. And finally, the 504 program continues to be an outstanding resource. Certainly, as we contemplate a rising interest rate environment, a 25-year fixed rate note is an incredibly powerful tool. The other great part of that particular program is owner-occupied real estate. So it enables a small business owner to build value on their, in terms of an asset, and allows for a third-party lender to participate in the deal. With that, I will yield back the time.
Thank you, Mr. Kelly. And I will recognize myself for 5 minutes. Mr. Kelly, earlier this month, we learned COVID EIDL funds had run out. And I am concerned that the agency did not have a more detailed plan to notify constituents about the changes in the program. Mr. Kelly, could you please let the committee know where the breakdown occurred and what do we say to our constituents who have been dealing with this confusion?
Sure, thank you, Chairwoman. First off, it's important to note that there were about 61,000 workable files at the close of business on May 6th. And all of those workable files across appeals, reconsiderations, and loan modification requests that are eligible for funding did in fact get approved for funding and have funds obligated, and that's as of Monday, May 16th. There is a population, for example, within the reconsideration, which was roughly about 9,000 applications for which folks will not be approved, were not approved, and that's the result of issues related to credit criteria, tax information, various issues. But I do want this committee to know and for the small businesses to know that we did honor all of the applications that were in before the funding expired and came in at the tail on May 5th and 6th. Second, it's important to understand what this population is. The program has been in wind down since December 31st of 2021, when applications for new borrowers were no longer allowed past that date. So for example, the 5.4 million startups that small businesses that came online in 2021 would not be able to access this particular product. But the 3.6 million borrowers that were made in 2020 are seeking loan modifications or reconsiderations. It's also important to note that the program does not allow a loan increase 24 months from the original note, past 24 months for the original note. As this committee knows, 3.6 million loans were originated in roughly 120 days in the spring of 2020. And so that 24-month period is tolling. And so we have exhausted the funding, as Chairwoman Velasquez said, and it's also timely because the loan increases were going to toll for 93% of
Okay, so this is what I want. We need a commitment from you to work with all the members, and not only the members of this committee, but across the board, and to provide transparency and finality to this process. Mm-hmm. So I will ask you to communicate that to the loan officers and district officers, mm-hmm, so that they are aware that that is a commitment that you made to this committee. I understand that SBA plans to transfer all disaster lending to OCA soon. We have seen the Office of Disaster Assistance do good work in response to major disaster, especially in Puerto Rico after Hurricane Maria, where ODA provided over $2.2 billion in disaster loans. Can you guarantee this transfer will not compromise the ability of SBA to respond to natural disasters?
Yes, and it's important to note that the Office of Capital Access will solely be responsible for the lending, but the Office of Disaster Assistance will continue and be involved in preparedness, which is obviously an important first step in any disaster.
Thank you. And Congress waived the personal guarantee requirement in the CARES Act to ensure co-ops and ESOPs could access PPP and EIDL funds. But for 7A loans, SBA continues to require an unlimited personal or entity guarantee, which virtually no co-op can provide based on their business structure. Given the precedent set with PPP to not require a personal guarantee for loans to ESOPs and co-ops, why does SBA continue requiring a personal or entity guarantee for 7A loans to co-ops and ESOPs?
So as Administrator Guzman has reflected in her public comments and maybe even before the committee, this is an important opportunity to ensure that employees get ownership in the small businesses and obviously to deal with succession planning, which I know from my lending experience is acute for the baby boomer generation in particular. This is an important tool, and we are working, for example, with the USDA, which also supports, as you know, loans to small businesses, specifically for co-ops. And with that guidance, we are working on addressing issues together with the lender.
Thank you. My time has expired. Now I recognize the ranking member, Mr. Lukemeyer, for 5 minutes.
Thank you, Madam Chair. Welcome, Mr. Kelly. In your opening statement, you briefly discussed the SBA's direct forgiveness portal. On the morning of August 30th, 2021, an email signed by you was sent to PPP lenders. You state, and I quote, "Going forward, the SBA will be conducting independent outreach and audits on lenders who have not actively communicated to borrowers on the availability of forgiveness. This outreach will be primarily focused on those lenders who are not participating in direct forgiveness. To avoid these lender audits, we would encourage you to opt in to direct forgiveness and maintain an active and aggressive outbound campaign to your PPP borrowers." Why do you think it's necessary, Mr. Kelly, to threaten the lenders like that?
I don't believe that I was threatening. What we were responding to was banks communicating directly to the Office of Capital Access personnel that they were withholding starting forgiveness process in order to smooth out earnings across 2021 and 2022. So at the time of that note, what we were trying to help was the small businesses that were also notifying the office that they didn't have access to a portal in order to seek forgiveness. The note, I'll grant you, if I could rewrite it, I would, but the sentiment was that we have tools that we made available for over 1,500 lenders that have serviced 2.5 million.
I thank you for that,
PPP
but
loans.
the tone was such that it looks like to me like you were trying to intimidate the lenders there into doing something, which begs the question, why do you think it's your job to manage the loan portfolio for the lenders? Don't you think that they know their lenders better than you do, such that if they felt that this person was eligible for forgiveness, that they would probably have contacted them? If somebody they didn't feel was worthy of forgiveness, they probably wouldn't contact them. I mean, I would leave that they're the lender, you're the guarantor in this PPP program. Why would you want to get in the middle of that relationship?
We wanted to get into the middle of that relationship because there were direct reports from small businesses that banks were not making forgiveness available for their borrowers. And so what's important...
Don't you think it would be better then to send out a reminder to the banks or update them on the fact that, hey, you realize that forgiveness process has started, you need to be contacting these folks. We think it'd be a good idea to go through your portfolio and take a look at it instead of trying to threaten them like that. That's not what SBA should be in the business of. Not managing their portfolio for them. That's up to the lender. That's not in your job description in this PPP program.
So I agree that let the lenders execute forgiveness if they in fact are doing that, and we support that. To your point, we do extensive outreach with respect to forgiveness immediately when I joined the agency beginning in March of 2021.
Okay, next question. According to SBA's Inspector General, to date, how much potential fraud was identified within the EIDL program?
So I don't believe that the Office of the Inspector General has stated an estimate of exact fraud. What they have done is a series of reports that reflect estimates of improper or ineligible loans. For example, the largest bucket, which reflects the number that you're quoting, is the fact that in 2020...
I haven't quoted a number yet, Mr. Kelly. I was waiting for you to do that. The number is, in their reports, is $84 billion that they anticipate could be fraudulently accessed funds. How much was identified in the PPP program?
So again, there has not been a definitive number released by any of the auditors. What is true about both of the programs is that there were choices made in the 2020 in both programs, which created the opportunity for an increased likelihood of fraud. So for example, in PPP, specifically, one of the audit findings referenced 50,000 duplicate loans. That was the direct result of a decision by the Secretary of the Treasury at the time to make the loan accounting system, CAVS,
I understand
the
the problem. In their report, they're talking about roughly 5% of the loans to be fraudulently accessed. In your opinion, when you look at 20% versus 5% roughly, did the private sector do a better job of getting these loans out and preventing fraud?
Well, they're two different programs. So, for example,
why are they different then? In what respect do you feel they're different? That they were able to, one, not prevent fraud, and the other one at a minimal rate versus the other one with a 20% rate?
Well, first off, I don't agree that the IG or any of the auditors has identified the percentages that you're speaking to.
Well, Mr. Kelly, all due respect, all you do is you take the amount of money that's going out the door, you take the amount of money that they think has been fraudulently accessed, and you divide that out and you come up with a percentage. One is roughly 20% on EIDL and one's roughly 5% on the PPP. So my question is, if the direct lending of SBA is resulting in a 20% rate versus the private sector is only 5%, we got a problem. And all I want you to do is acknowledge the fact that that is the case. And you have two separate entities here who are direct lending, and there's a big difference in the results.
Yeah. So
that has to be acknowledged. You can't deny the facts. It's in the reports.
Sure. What I can acknowledge is that in the PPP program, for example, the top 25 depository institutions in the United States originated 96% of their PPP loans to existing customers. Those existing customers had already, as you know, gone through KYC and were on the books either as depositor or loan borrowers. For community banks, that number was 83%. The disaster loan program is a credit not available elsewhere last resort program. As you know, and the committee reflected in the Economic Aid Act,
the point, though,
the fact that there was a need for
all due respect,
folks that
Mr.
had
Kelly,
not
the point,
funding.
you're taking my time. The point is that there are things in place that help minimize fraud in one situation that are not there in the other that we need to take a look at. I thank you. I'll yield back.
Time has expired. Now we recognize the gentleman from Pennsylvania, Mr. Evans, for 5 minutes. You're muted.
Mr.
Evans.
Thank you, Madam Chair. Some of my constituents, business owners, have been working with the SBA on EIDL reconsideration for a year or more. Several of them have been in process for so long due to reasons beyond their control, such as tax document expired between SBA loans, have been delayed in submitting the document to the IRS. Can you explain the deadline, the timeline going forward for these cases and those that are either submitted or approved status?
Yes. So as I mentioned earlier in the testimony, there were roughly 61,000 outstanding workable or eligible files, which meant that they were either seeking an appeal of a previous decline a reconsideration of a previous decline, or a loan modification, which is a increase to their existing loan. One of the persistent challenges in this particular program is the disconnect between the choice that was made in 2020 regarding not validating tax income for 3.6 million borrowers versus the desire in the Economic Aid Act for 2021 to require, again, as is the case historically for natural disaster lending at SBA, to verify tax income. It is important to remember that when we are the tax information that we are seeking for these borrowers is their 2019 filing. It's now May 2022. For the reconsideration requests, in almost all cases, the original denial is due to a discrepancy that has been reviewed by a loan officer with respect to an amended tax return. The amendment is seeking a higher increase amount than the borrower is eligible for, and not surprisingly, the borrower is not happy with the outcome, which, as I know from lending, is an unfortunate byproduct of making loans. The thing that's important about 2022, as I mentioned earlier, is that the opportunity for seeking loan modifications begins to toll because the original notes for 93% of the loans were originated in 2020, and the 24-month window will toll.
Has money been set aside for applications that have been approved but not received funding?
Yes. So there are approved and obligated borrowers who have not executed closing at their own discretion, and they will continue to have the opportunity to close the loan or not close the loan, in which case we will cancel it. But in all cases, we began communicating to the outstanding applicants for loan modifications, reconsiderations, and appeals beginning in February, and notified them directly through email, directly to their account, and spoke directly through call center and loan officer response to the actual borrower's requests.
Will those in submitted status be able to receiving funds?
So it depends on what you mean in terms of submitted, Congressman Evans. So I apologize. Are you referring to new applications or loan?
Those submitting in status, will they be able to receive funding?
So yes. So all of the submitted, eligible reconsideration, appeal, and loan modification requests that were received on or before May 6th, totaling roughly 61,000 requests, will have been processed, and those that are eligible for funding in the case of a loan modification increase, which is roughly 40,000 of that bucket, have received notification, and those funds will be obligated for them to close today or at a later date at their discretion.
Thank you. I yield back, Madam Chair. Thank you very much.
The gentleman yields back. Now recognize the gentleman from Texas, Vice Ranking Member, Mr. Williams, for 5 minutes.
Thank you, Madam Chairwoman and Ranking Member Lukemeyer. Mr. Kelly, I have 3 questions. I've got a bunch of questions, but I'd appreciate you keeping your answers to a quick yes or no on these first 3 questions. Do you believe the SBA, regardless of who is in the White House, should fight for lower taxes, less regulations, and advocate for Main Street America?
Absolutely believe that the SBA should fight for small businesses.
Regardless of who's in the White House?
Correct.
Do small business owners prefer capitalism over socialism?
I can't speak for small business owners.
But do you think that capitalism built the country, not socialism that we see today in the Biden administration? Do you think that when you go out and see small business owners like myself, that they say we'd much rather have capitalism than socialism? I mean, are you a capitalist?
Am I a capitalist? Yes.
Okay. But do you think Main Street America wants that over socialism?
I can't speak for all of Main Street America.
Well, okay. Well, you work for the SBA, but okay, that's fine. The other question would be, have you ever owned a business that, because we were talking about your private sector experience, the chairman was talking about that. Have you ever owned a business and started it with your capital and met a weekly payroll?
No, I have not.
but you can still feel like you see the issues that face small business, even though you haven't had that experience.
For 6 years between the Obama administration and the Biden-Harris administration, I was built a lending practice for asset-based lending and business acquisition loans, and made $500 million of loans available for small businesses. So yes, I feel pretty fluent in the issues related to small
But
business.
it's also different when you have your own capital behind it, and we have some people in this administration never owned a business either. That's a problem we have. So as a small business owner myself, I still own a business in Texas, have about 300 employees that work for me. For over 50 years, I can tell you that President Biden's SBA is out of touch with Main Street America. Inflation continues to skyrocket as Americans struggle with the rising cost of gas and groceries. You see that, even from your perch, how inflation is choking small business. Not to mention that America's labor force participation rate is close to a 45-year high, leaving small businesses understaffed and on the verge of shutting down. Meanwhile, through all this, the administration's fiscal 2023 budget requests millions of dollars under the SBA's lending program to go towards climate initiatives. We got businesses out there begging to be able to participate, stay open, and you're out there talking about climate initiatives. Now, it's shocking to me that the SBA would request more taxpayer dollars for climate change in lieu of directing money to provide businesses with access to capital. I can tell you that I know businesses in my district in Texas, they're concerned about their ability to compete in the future and are looking to the SBA to be a nonpartisan resource that has their best interests in mind, and they are not worried about climate change. So, Mr. Kelly, as you talk with small business owners like me, what is a bigger concern today, climate change or inflation?
Well, specifically for the natural disaster loan program, which we've talked about here, the fact of the matter is that the number of and the impact of natural disasters has been on the rise. And so what the budget refers to is the fact that we are going to continue to need to make both consumer loans for property damage deltas that are not made up by their private insurance to put homeowners back in their homes, as well as small businesses for working capital once they've been leveled by a tornado, an earthquake.
Of course, this is before they've been leveled by a tornado, earthquake. They just want some help.
Yes. so
And
in
you're
our
out there absorbing a budget full of climate change, which people are not interested in right now, that takes cash flow away from those businesses.
So for the businesses that are wrecked by the natural disaster, that's an opportunity for them to get back on their feet. In our core programs, for example, during the Obama era, we leveraged the 7A program to do a dealer floor plan financing report. So you own an auto dealership.
Yeah.
We stood in when the dealers were being closed and shuttered, when there was the potential of the auto manufacturers going down, and provided 7A capital. That was done through community banks to support auto dealers to make sure that they could get access to floor plan financing. So you're right, we have two programs. One that is a Uber credit not available elsewhere, which is to say when a business owner is at the worst moment in their life, we stand in to help them.
Okay,
And for the core Main Street businesses, we provide working capital, owner-occupied real estate, and business acquisition.
Don't forget small businesses that need operating capital before the big storm, as you refer it. Okay, that's ready capital they can employ people with and create more jobs.
Time has
As
expired.
opposed to something down the future. Thank you. I yield my time back.
And the lady from Kansas, Ms. Davids, is recognized for 5 minutes.
Thank you, Chairwoman. And I'm glad we're having this hearing today. As the chair on the subcommittee on economic growth, tax, and capital access, I'm really glad that we're taking time to work with the Office of Capital Access. This hearing comes, of course, at a critical time. Just recently, the SBA announced that the COVID EIDL funds have been exhausted, leaving a lot of business owners, particularly in the Kansas 3rd, frustrated and disappointed. I know my office has been working with a lot of small businesses that have had trouble getting their EIDL applications processed in a timely manner, whether that's because of the IRS or SBA processing delays. Eligible small business owners have been extremely frustrated to discover that after months of paperwork and back and forth with government agencies that there's not funding available for them, and that's of course not through any fault of their own. I know Mr. Evans and a couple of other people have touched on this. I want to make sure that I have a clear understanding of the process going forward. When you were responding to Mr. Evans' question, I believe that you said that even in instances of applications being, I guess I'll give a hypo. If a business applied and was inappropriately flagged for fraud, and then ultimately their application is determined to be eligible, there are funds available for those applicants. Is that correct?
There can be funds made available. There aren't currently any funds available for that. What's important to note is that in your hypothetical, that particular borrower has been seeking that particular reconsideration and had over 14 months to seek the loan increase. So what I can say is that for 98% of the applicants, we respond to those requests in less than 30 days. And the funding for the loan modification increases, the average size of which is about 100 to 200,000, takes place in less than 3 weeks. And for the $2 million loans, it takes about 5 weeks to process. So as of May 6th, the total inventory of those challenges, and I want to say to everyone on the committee, and you represent it, if there are any individual issues that you want me to chase down, I'm happy to do that. But in terms of the workable inventory, we did go through all of those and make sure that those folks were funded.
Okay. And is that regardless of whether we're talking about IRS delays or folks being inappropriately flagged for fraud, going forward, just want to make sure that that everyone has been, because we'll definitely follow up with any constituents from the Kansas Third who have seen these delays, who have been extremely frustrated with the back and forth or lack thereof. I just want to make sure that what you're saying is that your understanding is that you have essentially exhausted all of the applications, whether somebody was inappropriately flagged or for fraud or went through, the delays with the IRS, that all of those applications have been processed, and anybody who's been approved has already received their funding.
Yes, and what I'm also saying is that when members send us constituent challenges, it falls into two buckets. Either they did not file in 2019, and they're seeking an increase for more than a year because in 2020 they were able to get the advance as well as the loan up to $150,000 without needing to validate taxes, which of course is the subject of all of the audit reports. For 2021 population, the 300,000 have had the year to seek new applications. New applications ended on 12/31. And for the second predominant reason is amended returns, where the increase request that the borrower is seeking is higher than the previously stated taxes. And so in those instances, there is interrogation on the part of the loan officer and the team leads, as there should be, to determine that. With respect to fraud per se, eligibility, those issues are dealt with pretty rapidly with respect to, as soon as the flag fires, and it's an automated flag. So it's most likely that the constituents issue is related to taxes.
Okay. All right. Well, thank you, and we'll follow up. Thank you, Chairwoman. I yield back.
Great.
Gentlelady yields back. Now we recognize the gentleman from Pennsylvania, Mr. Muser, ranking member on the Subcommittee on Economic Growth, Tax, and Capital Access.
Thank you very much, Madam Chair, and I thank the ranking member, Mr. Kelly. Good to be with you. So, do you think that the expertise and direct community ties for private lenders working with the SBA for 7A loan program is a successful initiative, a successful partnership?
For $370,000 loans, which is the average loan size for owner-occupied real estate and business acquisitions, which is 3/4 of the loans originated each year, yes, absolutely. The 10-year amortization period for business acquisitions, there's not a better product.
So you actually think SBA is better off doing many of those loans on its own?
I think that that we need to exhaust all distribution channels across the full spectrum of borrower need.
The EIDL loan had such fraud, and PPP had such minimal fraud. Why, you're a private sector guy, why in the world would you want the SBA that's understaffed? People throughout Pennsylvania anyway are working real hard, doing a decent job with what they have available to them. They don't have the tools to do it at a high level of excellence. And you're saying that you want to take on the direct lending? That sounds crazy to me.
Well, I'd point you to the state of North Dakota, which has had a public bank for over 102 years. The Kansas City Fed recognizes that it has the highest consumer and business borrower deposit density amongst
completely
community
disagree.
banks.
Completely disagree. That doesn't make any sense. Look at the EIDL funding and the PPP.
There's a
just
public
itself.
bank in
You're
the
also,
state of-
I'll reclaim my time. Also, the idea that you're spending millions of dollars, as Mr. Williams just brought up, for climate change. While have you walked through a few small businesses lately?
Yes.
All right, they got a lot of issues taking place.
Yes.
Okay, and access to capital is a real important one, and you're focused on the wrong things. I mean, why would you be focused on voter registration? Why'd you put your hand up first when President Biden said, "Hey, let's turn the federal agencies into voter registration arenas"? Why would you say, "Hey, we got nothing else to do. We'll do some voter registration for you"? Does that make sense to you?
Allowing people to vote, yes, it does.
That's not the function of the SBA, okay? Yeah, it's nice if you hand out ice cream too, but that's not what your role is. It's absolutely remarkable, and it doesn't make any sense that you wouldn't bring some focus to this important authority that you have and advocacy, but you don't see it that way.
I definitely bring a focus every day to the access to capital issues. And so right now, working on the full spectrum of working
Man, I can see why you're not in the private sector. Let me ask you
spent
this.
the bulk of my career in the private sector, Congressman.
You know, well then, why would you be expanding your duties while we have the main function is running so poorly? Okay, EIDL loans have run out, right? You're aware of that? The funding for EIDL loans?
Yes.
Okay, I got a lot of businesses that were counting on those loans. If we didn't have billions, $80 billion in likely fraud, those loans wouldn't have run out. And if they were done in partnership with community banks, knowing the customer, that wouldn't have happened, because look at the PPP. So I have small businesses that in need of capital, and instead we sent it to fraudsters, okay, because you took it on yourself and you want to expand that. Okay, can you understand where I'm coming from, that I have some difficulty in that as this committee has oversight of your work? So onto the EIDL funding. Do you have any plans what is the plan for bringing some additional funding for the EIDL lenders, for the EIDL loans?
So we will work with this committee, appropriators, and the Office of Management and Budget to properly fund the program. With respect to the EIDL program in particular, there's no doubt that there's going to be continued demand for a 3.75% fixed-rate loan with a 30-year amortization period. But there are other options in the marketplace, as you and other members have referenced, that those borrowers are going to be able to access. And one of the key tools for that will be the 7A product, for which thousands of lenders
Long
will
answer.
take
I'm just
advantage.
looking for when it's going to be funded so these small businesses can get the loans that they've been counting on. Just real quick, the 504 Express pilot program that was supposed to be done December 22, I know you guys are busy, but when will that be implemented? When will that finally be created and done?
Shortly. So the regs will be promulgated in short order.
I yield back, Madam Chair.
And we recognize the gentle lady from Pennsylvania, Ms. Houlihan, for 5 minutes.
Thank you, Madam Chair. Just making sure that you can hear me okay.
Yes, we can.
Terrific. And thank you, Mr. Kelly, so much for your testimony. The SBA, my questions have to do with some inadvertent consequences, unexpected and unintended consequences. The SBA estimates that over 300,000 PPP borrowers have in good faith made miscalculations. The miscalculations have been made either by the borrowers themselves or by the lending organizations. On average, they've ended up with excess loan amounts in errors of around $12,403, which of course poses an unexpected and potentially crippling debt for many of our borrowers, despite in many cases the loans being used and spent on what would be considered forgivable uses. So in other words, the SBA's current process, had a simple technological input or error occurred, could have impacted or would impact some of our borrowers for years to come because of that mistake. We really need, I believe, to deliver on our promises to those borrowers that these loans can be turned into grants if funds were spent on forgivable loans. Or for forgivable reasons. So my question to you, sir, is will the SBA commit to making good on that promise and to helping these borrowers to get full forgiveness?
Yes, we'll commit to working with you and your staff and the committee to trying to figure out the right path forward for those particular forgiveness borrowers.
Excellent. I very much look forward to working with you and my staff working with you as well. Real quick, do you think that there's a legislative issue here, or is there something else that we can understand going on here?
I would defer to take this offline because while I am a lawyer, I'm not a particularly good one, and I don't want to speak out of turn with on the authorizing statute.
Okay, I look forward to that conversation. My second question is somewhat related. As the PPP program was also rolled out, the program rule changes were actually quite rapidly changed in some cases because of just the crisis that we were in and making sure that we were being as expedient as possible. The elimination of the agency's grace periods contributed to additional errors, such as improper documentation that was submitted by both borrowers and lenders again. So my question again is, does the SBA have any plans to be able to retroactively review those kinds of cases where the program rules changes may have also contributed to good faith errors?
Yes. So it's important to note that that there's been 10.1 million out of the 11.4 million loans forgiven. Roughly 65,000 have been purchased, and there's about 4,000 current appeals. The appeals process is for those denials, full denials that you're referencing. And in the case of partial denials, we do have a reconsideration process that we make available for those borrowers.
And is there, again, anything that I can be helpful, or this committee can be helpful in doing to help make sure that we, again, in the case of people who are just operating in good faith with the rules very flexible and very dynamically changing, understandably, is there anything that we can be doing to be helpful there?
Yeah, I think you've highlighted some areas, and happy to work with the committee and any members on the areas regarding errors in the calculation of the payroll amount. We do see that in terms of overages, as you referenced, and one of the challenges is that creates for the borrower. So, absolutely happy to work and try to solve this and get to the bottom. And I think we should all feel good, and I give the committee and obviously your colleagues in the Senate a lot of credit because we kept the faith with borrowers and lenders. These loans were supposed to be forgiven. And if the lender made them, they would have the option to forgive, and by and large, that has been executed. But you point out an important group that might be at the margins that we should work on.
Thank you. I appreciate it. I have very limited time left, but I would love to take for the record a question that is always pressing on me, which is the accessibility of capital to women-owned small businesses. The small businesses that are women-owned have loan sizes that are 41% lower than those that are owned by men. Furthermore, on average, the credit score for women-owned businesses tends to be much lower, 14 points lower. I only have 16 seconds left, and so probably no opportunity for you to answer, but would love for you from the record to be able to talk to us about what we are doing, what your office is doing to level that playing field, and what can Congress do to be supportive of those efforts. And with that, Madam Chair, my time has run out and I yield back.
Gentle lady yields back, and now we recognize the gentleman from Florida, Mr. Donalds, for 5 minutes.
Thank you, Madam Chair. Mr. Kelly, thanks for coming in. A real quick question. This is to piggyback off of the final question from Mr. Muser dealing with the 504 Express program and when essentially the regs were going to be written for this program. You said shortly. What does that mean?
It means in the next 30 days or so in terms of being published.
Okay, so in 30 days, that should be out there so small businesses can take advantage of this.
Yes.
Okay, all right. Wanted to get some more clarification because words have meaning here, in our process. Real quick question. So what is the impact, in your view, of the rising interest rate environment on the 7A program, on the 504 program? Obviously, the Fed is on the move. My view, they're late to the game. They should have been doing this earlier, considering the inflationary environment. But what's your view of the impact of rising interest rates on those programs?
Well, it makes the product that much more valuable for the small business borrower that receives it. So, for example, you referenced 504. That's a fixed rate tool. So obviously, borrowing with money today and paying back later is an advantage with a fixed rate note. And while the rate has gone up 50 basis points in the last couple weeks to a point on the baseline rate, overall the base rate is still low historically. So the other advantage of these particular products is that they allow for longer amortization periods, which lowers the monthly debt service associated with the debt, which means that there's less cash going to the debt. And for companies that have to pivot, companies that are looking for growth, business acquisition tool in the 7A program, for which 30% annually our loan proceeds go to, is an excellent opportunity to buy a business with little to no money down in the particular program.
Let me ask you this question, because you mentioned your private sector experience. I had to go into another hearing. Mm-hmm. So real quick, just can you give me a quick 15 seconds on what your private sector experience was?
Sure. I worked for a community bank based in Wilmington, North Carolina, that makes loans nationwide to small businesses for about 6 years. Prior to the Obama administration, I worked for Schulte, Roth & Zabel, which is a law firm in New York City. Worked mostly on M&A as well as structured finance. Prior to law school, I worked for a for-profit educational company that helped children with ages 4 to 14 with enrichment and remediation. That was a retail store, ran a P&L for that, and then worked for Chubb Insurance Company as well as Merrill Lynch in the muni bond division in the late 90s.
Okay, so let me ask you this question. So we have roughly 30 million small businesses in the United States. Capital is basically required by everybody. What is the capability of SBA through direct lending to actually take what part of the market share do you anticipate SBA can actually access?
So I would reference the previous Congresswoman's point about women-owned borrowers and earlier references to startups.
But hold on, Mr. Kelly. I got a minute 33. If you guys are talking about doing direct lending, of all the small businesses that exist that are looking for capital, what percentage of overall small businesses? You guys have had to do some analysis on this. Just what's the percentage? 10% of small businesses, 25%, 30%? What do you think SBA's real capacity is and capability?
So I don't know the total capacity. What I can say based on market demand is that the hardest challenge, and Chairwoman Velasquez referenced this in her opening statement, there's been a dearth or a decline in loans, particularly under $50,000.
You do know why that is, right? We've shut down community banking in the United States through Dodd-Frank regulation. In my congressional district, we had 75 community banks when I was in community banking. 75. Now we have 5. It's 10 years, 15 years. From 75 to 5. That's what Washington has done. So my question is, and again, because now I'm down to 25, 28. My question is very, very simple. If SBA was going to go out and do direct lending, essentially create a federally controlled bank, if you were going to go out in the private markets and make your own bank, you would have to have an understanding of what percentage of the market you were going to be able to anticipate counting on as customers. So what percentage of the overall market does SBA have the capacity to actually take on as direct lending customers?
So I assume you're referencing to this committee's language that was put in the Build Back Better bill with respect to direct lending. If that's the case, in particular, what that language called for, and I think it was appropriate, was for funding loans under $150,000. And what the language sought to do was to create parity between the SBA's direct loan, for which the agency has direct lending authority today and has had it historically, to make small dollar loans for which there is a gap and there is an efficiency challenge recognized by all banks.
Only thing I
Time
would
has
argue
expired.
is I don't think the SBA really has a clue of what its capacity really is.
Time has
That's my point.
expired. The gentleman from Minnesota, Mr. Phillips, is recognized for 5 minutes.
Thank you, Madam Chair. Let me first associate myself with the remarks of my colleague from Florida relative to community banking. I agree. I don't want to see more erosion. I want to see more propagation. I've seen the great value they bring to our communities and share your concerns. Mr. Kelly, let me start with you and say thank you. There's a lot you could be doing other than serving the public in this capacity. The SBA, in my estimation, is a uniquely American institution supporting entrepreneurship and its ecosystem, and I'm grateful. We have an obligation to provide oversight and accountability, and we all have concerns about fraud, about some of the programs, but I want to thank you. A colleague who was so critical of the SBA just moments ago, according to news reports, secured $1 million plus PPP loan. I want to say thank you on behalf of his enterprise and the hundreds of thousands that you helped save, and say thank you, most importantly, on every one of those little enterprises' behalf. With that said, there's a lot SBA could do better under Republican administrations and under Democratic administrations. I think we'd all agree. But let me start by just affording you a few moments and express to us, what do you think we could do better, the SBA, you, your associates, relative to the provision of capital to small enterprises?
Thank you. The single most important thing that I think we can do better is build off of what worked universally within the PPP program for our lending intermediaries, which is to support a simplified product that can leverage technology, that can lower the cost of new customer acquisition, as well as the controllable non-interest expense associated with making a loan. And to make available the secondary market so that the guaranteed portion of that loan can help banks lend beyond their lending limit for an important customer, or leverage the secondary market for liquidity and quarterly earnings. So to do that, we need to also build off of the expansion of distribution channels. So as I mentioned earlier, 600 community financial institutions supported $30 billion, more or less, of PPP loans. This is particularly important because the average loan size across that $30 billion was roughly $40,000. That particular amount is going to be absolutely critical when we think about the 5.4 million new startups that happened in 2021. For those new startups, if they go to the bank that I worked for or any other bank, they will obviously be in their first year or two of cash flow. Typically, community banks rely on the trailing 36 months to validate income from tax returns. So as a result, there is a market externality related to startups.
Sure.
And it is one of the most challenging aspects for any lender, whether you're a community financial institution or a large top four depository institution. So I think the things that we can do focus on making the rules simple. I commend the committee across multiple programs for simplifying, for example, some of the eligibility criteria for those programs with respect to affiliation, criminal background checks, those things. I think we should build off of that. With respect to the credit criteria for PPP, it was a formula, and so it lent itself to speed. And as a result, we saw, a huge participation within the first $385 billion from community banks. As I mentioned earlier, it is a fact that the state of North Dakota has a public bank for the last 102 years. It lends $22 billion currently of assets alongside its community banks. And in PPP, the largest lender a community bank lender in the state of North Dakota, made 1,000 loans with the same amount of branches as a top four depository institution, same state, but they only made 100 loans. So community banks are thriving as measured by the Kansas City Fed in terms of consumer deposits and business deposits. So I think that we should think about, and we've mentioned it earlier in the committee, public-private partnership means both halves of those equations. And the reason that community banks are struggling and declining is because of the pressure that is being put on them by the products offered by the top 25 depository institutions, which has led to a decline in their deposits, and it has made it very difficult to compete in terms of working capital options for small business borrowers that have high average daily deposits account numbers. So the opportunity to do what the
My
Bank
time's
of North
expired,
Dakota,
so we gotta
I'm
wrap up.
sorry,
Yeah.
got passionate about that.
No, and I wanted to afford you time, and I hope we can work together with you to help realize that vision. With that, I yield back. Thank
The
you.
gentleman yields back, and now we recognize the gentleman from Wisconsin, Mr. Fitzgerald, for
Thank-
5 minutes.
Thank you, Madam Chair. Mr. Kelly, so on July 28, 2021, SBA made changes to the PPP forgiveness by establishing the direct forgiveness portal. So there's been discussion already amongst committee members on the difference between the PPP loans that obviously were part of the files that were controlled and initiated by local banks compared to the SBA direct loans. So, there was an experience there that I think there was a little bit of talk about. And I get it. We were trying to get the money out the door, get it out as quickly as possible, and there were a couple of different avenues that could happen under. But the problem, I think, now is that there was very little communication between the SBA and the banks and credit unions on the forgiveness part of it. So because I'm in the district in the 5th Congressional, and I still hear about this now, that this is an issue that was kind of hanging out there and hadn't been dealt with directly. Do you guys still believe that, what was put in place and the due diligence or the underwriting related to that is still relevant? Or, should this be revisited now and include the credit unions and the banks in this full discussion about forgiveness?
So I guess, could you help me? I'm having a hard time. So with respect to forgiveness, so as I mentioned earlier, 10.1 million loans have been forgiven. 65,000 have sought purchase. Currently, we have an inventory of manual reviews of roughly 40,000, of which there are a total of 4,000 that exceed the 90-day window. 90% of that number stays in inventory for less than 15 days. Of the 4,000 over 90 days, all of them have hold codes related to eligibility issues that we are interrogating. So I'm not aware of challenges with respect to forgiveness.
They're basically making the case that the fraud detection was not significant enough in relationship to the SBA compared to what they were already doing. So right now it's created kind of two different categories of PPP loans that are out there, and I think there's a lot of credit unions and banks that are saying we simply kind of don't know where SBA is going with all this.
So I'm happy to take offline to better understand the issue. My experience with lenders, and we just recently attended the National Association of Government Guaranteed Lenders, and there's about 800 different community banks represented. There was not a reflection that forgiveness was having problems. With respect to direct forgiveness specifically, we add new banks each week, even to this day. We're over 1,500 representing 2.5 million loans under 150,000 that we're processing. And on a daily basis, the direct forgiveness portal is responsible for roughly 55% of the inbound intake. What remains outstanding of the 11.4 million loans is roughly 1 million loans from the 2021 population. for which the 10 months from the end of the forgiveness period is about to toll. And we saw an uptick last summer at this time related to the 2020 population. But I'm definitely happy to hear and would talk to any lender that's having a challenge specifically with forgiveness to assist.
Very good. I'll follow up with you on that. Let me just shift gears real quick. So we just introduced HR 7678, American Small Business Competition Act. It would increase loan amounts under both 7A and the 504. I think this is especially important as kind of the small business costs continue to rise with the goods and services and what we're seeing kind of with the economy right now. Have you guys looked at the $5 million and whether or not that's a sufficient loan max in this environment that we're operating in now as we continue to try and get the economy in a better place than where it is currently?
Yes, Congressman, I am aware of the bill and the language, and there is a continuum or a spectrum of small business capital needs that spans from the tiny loans that we were referencing earlier, where there's a gap, and what the language of your bill references, which is, for example, specific to supply chain financing today. Small businesses that are seeking to purchase in bulk are often facing a liquidity challenge because they need to front the money to the suppliers. And the increase in the amounts that, in order to be rank ordered by that supplier is necessary. For the banks, that proposition is not one that they're excited about because they're lending money today in hopes of getting an invoice at a later date. So I do think there's opportunities for us to work together to support working capital. Largely, the 4,500 community banks focus on residential mortgage and commercial mortgage loans, and they've stepped out of the line of credit or asset-based lending, which is the type of lending that's particularly needed when you're financing growth and supplies.
Thank you.
Thank you.
Gentleman's
Yield back.
time has expired. And now we recognize the gentleman from Maine, Mr. Golden, for 5 minutes.
Thank you. I quickly want to revisit something that brought up earlier by one of my colleagues. I believe there was an executive order having to do with agency-wide, department-wide, working on issues of voter access. And so, I think some people were talking about SBA kind of throwing their hand up, and I just don't think that's quite the case. I think it's important that people understand that you're appropriately focused on your mission, but you do have an obligation to be responsive to executive orders. I'm sure you would agree. So, totally fair for Congress to, voice opinions about perceived bad executive orders. No doubt, but I think that should be, appropriately targeted at the White House, and maybe as an associate administrator of your office, you're just being responsive in the way that you have to be. But somewhere in the cabinet, there's someone I'm sure who was pushing that EO, but it wouldn't have been your office. So I just wanted to clarify that for everyone out there. And I agree with the sentiment of my colleague, though, that your office should be focused on capital access. I think you're doing a good job demonstrating your grasp of the work that you do. So thanks for being here with us today. I want to talk very locally about a constituent that I have back home, but I think that their situation is very similar to many others around the country. So my constituent was working on EIDL application. They've been working with my office for months to get SBA to complete a review of their application. And there were difficulties with midstream changes to the applicant's personnel, and then with delays at the IRS. SBA's processes, however, also contributed to delays. So the applicant reported to us several times that responsibility within SBA for their materials changed frequently. And it was evidenced by redundant requests for information that they were asked to provide to a number of different SBA employees. And these requests seemed to stem from confusion about the applicant's organizational structure, which they were able to clear up with certain SBA contacts, only to then have confusion reappear when they encountered new contacts at SBA. And this led to extended periods in which there was little apparent progress made in the review. As of yesterday, neither the applicant nor my office is able to determine whether their application will meet the criteria for SBA to complete its review as laid out in SBA's May 13th FAQ. And we were informed recently that its status in SBA's system was, I guess, labeled as not interested, which is apparently being used as a holding pattern for certain applications. But it's unclear how this status maps to the review stages laid out in the May 13th FAQ. So while the applicant has finally received an IRS transcript, it's not clear whether there are remaining documentation gaps. And given all of this, including the fact that the application was subject to processing delays by SBA and the IRS, it seems unfair for them to miss the opportunity to at least have a full review of their application. So I'd like to work with you and your staff to, first of all, determine whether this application is in one of the stages that would make it eligible for completed review. And then second, if the application isn't on track to receive a full review, is there any way to get this on track? Or are there other ways in which your office can help them get access to the capital that they were looking at and that they clearly need? And of course, in a way that will work for them, similar to that EIDL program. Obviously had some very good loan terms that they're interested in, but if it's not this, are there other opportunities? And I'll follow up with your staff to make sure that you're, get more details on the specifics here. But, could you just speak a little bit about the process for constituents like this across the country? Like what kind of flexibility is out there, and how long is this going to take for your office to figure out?
Well, specific to the example, yes, I'm happy to take that offline and get directly into that. Broadly speaking, it is no doubt the case that the worst thing you can do in a business experience or a customer service experience, is to set the wrong expectations at the outset of the relationship. Unfortunately, when the COVID EIDL program was rolled out in 2020, 3.6 million borrowers, 93% of the total asset portfolio, were able to obtain $150,000 with none of the credit criteria that's normally applied either commercially or in this public program. So when they came back in for loan modifications, which this administrator made available, the process was by definition going to be more arduous because we were actually underwriting the eligibility you referenced in your remarks as well as the credit criteria. It's unfortunate for sure, and we've experienced it with those borrowers. So happy to work offline to address the issue. Yep.
Gentleman's time has expired, and now we recognize the gentleman from New York, Mr. Garbarino, for 5 minutes.
Thank you, Madam Chair. Mr. Kelly, thank you very much for being here today. I wanted to follow up a little bit, build off of actually what the previous member was asking. So your office oversaw the COVID EIDL program, correct?
Yes.
The application process?
Our office took over the program in July of 2021, yes.
So, if something moved from the pending status to I think there's, in your office, used something internally obligated, that means if the loan was obligated, that means it was either going to be funded or was being funded. Mm-hmm. Who determined, is that your staff or your office that determines if something hit the obligated status?
Yes.
So when you announced, or your office announced, or SBA announced that the EIDL money was done, there was no more. If something wasn't in obligated status at that point, did that mean they could not get any money? There was no more money available for them, right?
At that particular moment on May 5th, yes. However, as I referenced earlier in my testimony, there were around 61,000 workable files across people seeking appeals to a previous decline, reconsiderations of a previous decline, and then loan modification increases. We were able to process all of those that were eligible to be approved and be obligated funds. And we've notified those customers directly from the loan officer, and then they are the folks that are obligated have the right at their discretion to close the loan. And they'll have sufficient time, 180 days or more to execute that.
So they may not have been obligated, but they were they were appealing there was reconsideration. Were there any applications that were not under, that were not being appealed or reconsidered? Were there new applications that were not obligated that have since become obligated? Could have anything have happened through a congressional inquiry or something that would have moved something that was not obligated on that date to obligated if it was not a reconsideration?
Yes. So from the period of time from May 5th, May 6th, up until May 16th, your office perhaps and certainly others have made us aware of folks who were in the statuses that your question refers to. And we have dispositioned each of those instances. And so that might lead to an approval and being obligated. It also can lead to another decline for the reasons that they were previously declined, for example, a reconsideration. It's important to note that reconsiderations for the 24-month period, 8 out of 10 times that someone seeks a reconsideration, they're declined. So it's also important to note that because of the delta between what was required for the 3.6 million loans originated in 2020 versus the roughly 300,000 plus originated in 2021 that required tax income verification, that those folks from 2020 seeking a loan increase were denied the increase they were seeking 50% of the time. So it's absolutely the case that the experience has been frustrating, but as I mentioned to the previous member's question, when you set a different set of program expectations and 93% of the loans are originated under different expectations, that's of course going to create that scenario.
Okay, so nothing can be reconsidered now. Like if an application by May 5th had not been they were not obligated, everything was pretty much denied, correct?
Yeah, I think that
and the reason I'm asking is I have a couple constituents that had applications and they were never they weren't obligated. They never had an original determination. They were now denied because the funding was out, but they were sent a letter asking if they would like a reconsideration. So there's no extra money for a reconsideration of loans that were denied, correct?
There isn't. There can be money through cancellations, but it is more likely the case that the limiting factor for a particular borrower seeking an increase at this late stage, and keep in mind that increases have been available for 14 months.
But if they were denied, and then I'm almost out of time, but people are getting reconsideration requests, but the program is closed now. So
Yes,
I think there's a disconnect there, and it's really confusing a lot of my constituents.
The challenge is going to be that from the date that they sign the note, they cannot seek an increase beyond 24 months.
Okay, thank you.
The gentleman yields back. Ms. Chu, the gentlelady from California, is recognized for 5 minutes.
Yes. Associate Administrator Kelly, I am feeling the distress that some small businesses are experiencing in getting shut out of COVID EIDL funding due to agency errors or delays outside of their control. A couple of examples from my district. A small business owner in my district applied for a COVID EIDL loan increase well before the May 6th deadline, but because the IRS didn't send the SBA the required tax transcripts in time, the application was not considered complete and will be rejected. Another small business owner in my district applied for a loan increase more than 2 weeks before the deadline, but experienced a technical issue with the SBA's online portal. They immediately notified SBA and called the agency every day to see if the issue had been resolved, but they still have not heard back about the status of their application and are concerned that they won't receive funding. These are just two of the examples, but I'm sure that there are thousands more small businesses in similar situations. How is the SBA going to make whole the small businesses like this who had a lag in response from the IRS or who weren't able to submit their completed application due to your own agency's errors, is it possible to extend the deadline for these particular businesses?
What I would recommend, so what I would say to all the committee members, and I would recommend in this case that we address each individual issue. What I have found since July, when I took over this program, is that there's a lot of detail with each individual inquiry. With respect to taxes, I agree that we as a nation should prioritize helping the IRS with the 4506T modernization. There is a bill that was passed for the IRS to make available through API income verification. That would not only help us administer these programs, but it would be a tremendous tool for the commercial lenders, and it would directly impact small business borrowers because they would be able to get a faster quote at a lower rate because of the verification of the income. One of the lessons coming out of the Great Recession and the residential mortgage meltdown was stated income loans or so-called liar loans create challenges. It's absolutely the case that borrowers who could get a loan in 2020 with no income verification and are having issues with their 2019 tax filing are frustrated. It's important to note that the largest single request that we deal with from members or directly through our field offices relates to a disagreement over amended tax filings. This is to say that there was a reported income that justified a lower increase request that the agency did approve, and the borrower is seeking reconsideration of that by amending their tax filing and coincidentally demonstrating that they are now eligible for an increase over and above what they had previously filed. It's important to understand that we are all dealing with a balance of speed and certainty here, with the speed to get the emergency relief out and the certainty that we all want, and this committee has prioritized in the Economic Aid Act with respect to safety and soundness and mitigating fraud, waste, and abuse.
Well, what about the situation with the portal not being functional? That is SBA's error.
So by definition, there were 9,000 reconsideration requests that were pending on May 6th, and there are 4 million outstanding loans. So there are, in fact, thousands, literally, of folks who are frustrated with the process at any one time. But the scale and magnitude of the volume that we're dealing with, which is to say we've been approving roughly 40 to 50,000 loans a day since July, on an order of magnitude of $500 million to $1 billion in some cases, means that by definition there will be larger numbers across the board. Our call center response time is less than 42 seconds to pick up the phone. The longest wait time recorded since September is 17 minutes, and the average disposition time is 7 minutes. So there is opportunity to interact with a human and to dispose of these. And I'm happy to work with your member and the individual borrower offline to try to get to hopefully a positive outcome.
Gentle lady's time has expired. Now we recognize the gentle lady from New York, Ms. Tenney, for 5 minutes.
Thank you, Chairwoman Velazquez, and also Ranking Member Lukemeyer, and my Vice Ranking Member next to me, Mr. Williams, another small business owner. And thank you, Mr. Kelly, for being here today. Over the past, and I know you're going to understand this completely because you're a Colgate graduate. Over the past few decades, too many of our communities have been left, behind by manufacturers. Many of the businesses moved to China. You know that as a person who lived in Hamilton, New York, for a few years of your life. my mom's hometown. This has been really exacerbated by the reality that capital today is really hard to get, and we are relying on SBA in many of our businesses. A lot of the money tends to be focused on inner city, big city hubs, so Boston, New York, San Francisco, and yet it's disproportionately not going to areas like Hamilton and rural upstate New York that I represent that have capital-intensive businesses in the manufacturing sector that have long-term profit horizons, but it takes a lot more capital to get them up and running, but they have longer-term prospects, and also more job opportunities for people in these communities, especially everyday Americans. And I introduced a bill called the American Innovation and Manufacturing Act, and that was to address this imbalance. I think there's a place where small business could be really helpful in this. It would provide flexible financing. We have also great people in the audience here today who are working on providing private lending options to our SBA, through SBA, and also to our small business community. But my first question to you is, right now, we have got this situation where the PPP and the COVID programs are going to take about a decade to close out. But the SBA and the congressional Democrats are pushing to create new programs for them to direct new lending. And I know you've been tackling questions all morning on this. So even though that's happening, with the SBA's current issues managing the fraud and difficult loan cases in the PPP and EIDL programs, why should we trust the agency to continue to take on new types of programs that are more diverse? And why do you not see a need to move to the private sector using partners like community banks and others to help our underserved and rural communities? I know there's a lot there, but if we could address, we're creating all these new programs, why aren't we going and using these private sector type lenders and institutions who are really going to enhance the SBA's role and take a lot of that away from sort of a larger bureaucracy that you're describing today has been very difficult to manage?
So first, I would say that you're absolutely right that the choices made in 2020 with respect to the safety and soundness measures for PPP and COVID EIDL created or increased the likelihood of the challenges that are highlighted in the audit reports that reflect that. What is also true is you'd be hard-pressed prior to that to find an IG or GAO audit report discussing either natural disaster lending or the core 7A and 504 programs with respect to fraud, waste, and abuse. So it is absolutely the case that these extraordinary programs that met an extraordinary plague are outliers. So I believe you should feel very confident that in the agency's ability to administer programs without fraud, waste, and abuse, because we've demonstrated that for the bulk of the agency's history, with the exception being the choices made in 2020.
Okay.
Secondly,
quickly, because I want to ask one more question.
Sure. Secondly, with respect to your working capital situation, I completely agree. The chairwoman in one of the versions that this committee voted out with respect to direct debenture, and one of the programs that's highlighted in the president's budget goes directly to helping third-party lenders, private lenders, provide working capital solutions through certified development corporations for the type of asset-based financing that you are looking for, specifically for manufacturing. So would love to work with your staff and the committee more on that as well.
Thank you. The last question I have is, when the Paycheck Protection Program was created by the CARES Act, reauthorized in December of 2020, we applied affiliation rules prohibiting SBA from issuing and forgiving PPP loans to entities with more than 500 employees across their affiliates, and it only excluded hotels and restaurants. However, we've since learned with various witnesses before this committee that the SBA and your office have since forgiven illicit loans from 34 Planned Parenthood affiliates totaling over $65 million. Considering Planned Parenthood has more than 16,000 employees, well beyond the 500 employee threshold, what was the reasoning behind illicitly forgiving these loans?
Time has expired.
I'd be happy to take that offline or in person if possible.
The gentlelady from California, Ms. Kim, is recognized.
Why isn't he? Can I get that question answered offline?
I recognized.
If
I can hear you.
I just want to make sure.
Give me a second, please. Mr. Kelly, would you provide a written response to the gentlelady's question from New York?
Sure.
The gentlelady from California is recognized for 5 minutes.
Thank you. Thank you very much, Chairwoman and Ranking Member Lukemeyer, for holding this hearing. And I want to thank our witnesses. Mr. Kelly, I really want to thank you for being with us today. I echo many of the issues my colleagues have raised today, and I am concerned that the administration is moving away from SBA's core mission, which is to help small businesses prosper and protect their interests in order to preserve free, competitive enterprise. But instead, the administration and SBA should be focusing in using existing resources to operate more efficiently and improve its responsiveness to small businesses and entrepreneurs. According to recent report by the Office of Inspector General found that for some loans totaling $66.4 billion, SBA did not meet the 90-day statutory requirement to remit forgiveness payments to lenders. Additionally, the report states SBA did not meet the 90-day requirement for over 98% of loans over $2 million. So, Mr. Kelly, why is the SBA failing to meet the 90-day statutory requirement?
It's not any longer. The report that you're citing references the forgiveness applications over $2 million that were outstanding as of March of 2021 when I took over the office. At that time, there was a population of about 60,000 loans that had not been processed in a timely manner. The previous administration did not begin forgiveness review of manual reviews until November of 2020, despite the forgiveness portal opening August 10th of 2020. From March of 2021.
More about the plan that you're working on and how would it help?
I'm sorry, I didn't.
Or how is SBA meeting the 90-day requirement right now?
We are meeting the 90-day requirement. In fact, we're actually exceeding the 90-day requirement of the current workable inventory with respect to manual reviews, of which there's roughly 40,000 at any one time. 90+% of those will be turned in less than 15 days. There is a population of 4,000 that have exceeded 90 days due to hold codes related to fraud, waste, and abuse that we are interrogating, which reflects that. I'd also be happy to talk to any of your constituent lenders that participate in the PPP program that have any outstanding issues with any loan greater than 90 days.
Okay. Well, it seems that we have a clear case study on the effectiveness and efficiency of the successful public-private partnership versus direct lending. On one hand, the EIDL program dispersed loans on an average of 49 days during the early days of the pandemic, and it had almost $85 billion of potentially fraudulent activity. On the other hand, the PPP, as a public-private partnership, took on average 7 days to disperse loans and had approximately $4.6 billion in potentially illegal behavior. So, Mr. Kelly, based on these numbers, in your opinion, which model did a better job at dispersing loans in a timely manner while protecting against fraud?
So I think both programs, as measured by the audit report, deserve a lot of improvement based on choices that were made in 2020. Each program is different. The objectives, for example, within the PPP program, were to originate a forgivable note where the lender was held harmless, was not required to verify the payroll amount, and as I mentioned earlier, by and large, lent the loan to an existing customer versus a Uber credit not available elsewhere disaster loan, which was critical lifeline for the population that was widely reported in 2020 as not being able to access PPP due to being underbanked and underrepresented across the banking footprint. Second, with respect to the number that you all are aggregating with respect to the IG reports for COVID EIDL, the lion's share of the number, the lion's share of the use case that makes up that number refers to the sole proprietors, including employee numbers, on their applications for the advance, which was distributed in 2020, and not having a requisite EIN number. The IG has classified that not technically as fraud per se, but as being ineligible, and their justification is the absence of EIN, which is a requirement for a sole proprietor declaring employees.
Time has expired. The gentleman from Minnesota, Mr. Stover, is recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Ranking Member Lukemeyer, for holding this hearing. Associate Administrator Kelly, I appreciate you being here today. In your testimony, you mentioned that 5.4 million Americans filed an application for a new business in 2021. You also state that as the SBA transitions its focus from pandemic relief to its core mission, the agency has never had more startups to support. Would you say that adding $201 billion in additional regulatory cost and over 130 million in new compliance hours for small businesses, as the Biden administration has admittedly done, are supportive actions for these 5.4 million new startups?
I think the regulations that you're referencing are appropriate for the industries that they are overseeing. And we've seen time and time again that if we don't have the proper rules of the road, it's the small businesses that actually are disadvantaged, because the major corporations are able to use their vast resources to a comparative advantage. So I agree with you that 5.4 million small businesses absolutely need fairness across the board. And obviously, the Administrator Guzman is their voice.
So would you agree that $201 billion of additional regulatory costs for small businesses is not wise?
I agree that you're citing an aggregation of the PRA citations in the notice of comment rulemaking, for which the public will have an opportunity to weigh in on those rules. I'm also in agreement that for specific industries, we need to have fair rules of the road so that there is a competitive landscape for small businesses to compete.
We certainly want a competitive landscape. And adding these are the Biden administration's own numbers, adding $201 billion of additional regulatory costs is unacceptable as we look at COVID through our rearview mirror. From the budget proposal, it is clear that the SBA administrator is looking to promote her own goals and initiatives rather than deal with the fallout pandemic. The pandemic may be over, but the responsibilities of this agency certainly are not. Idle loan payments are going to begin soon. More fraud than we already know to exist is going to bubble up. Innocent people are going to get hurt. This leads me to my next question. How is this agency managing its resources? Are you directing money away from incomplete tasks for the administrator's wish list initiatives? Because according to your budget justification, the SBA seems to think it is more prudent to use taxpayer dollars to pay off environmentalists than help small businesses that are facing skyrocketing inflation, a labor shortage, and a continued supply chain crisis.
I'm sorry, I didn't catch the end of your question.
How is the agency managing its resources? Administrator's wish list, it seems like the administrator is putting a wish list forward. I want to know your budget justification. The SBA seems to think it is more prudent to use taxpayer dollars to pay off environmentalists than help small businesses that are facing skyrocketing inflation, labor shortage, and a continued supply chain crisis.
So I'm not aware of the budget paying off environmentalists. What I am aware of is the increase in the frequency and the aperture of natural disasters nationwide and in the territories. And what's absolutely paramount, and as you heard me answer to the chairwoman earlier and promise, we need to make sure that there is never a instance where someone cannot receive natural disaster lending, either on the consumer side to make up for a delta between their property insurance and what the true physical damage is to their home, and for the small businesses' working capital. We are focused on providing lending and capital for growth. Growth is important now as ever, and fixed rate products are obviously a unique opportunity leveraging the 7A and the 504 program. The last thing I'll say is that I believe that this country at this point is truly served by this administrator, given her experience, not just in the Biden administration, but being on the ground when the pandemic was unfolding in a similar position for the state of California, which is the 6th largest economy. So I believe that she understands and has a full grasp of the issues and concerns that you've highlighted.
I expect as the associate administrator, you would make those statements about our administrator. Madam Chair, how much time do I have left?
Your time has expired, sir.
I apologize, and I yield back, Madam Chair.
Gentleman yields back, and now we recognize the gentlelady from Texas, Ms. Van Dyne, for 5 minutes.
Thank you, Madam Chair, and to the ranking member for holding this hearing today. And thank you, Administrator Kelly, for appearing before us. This hearing comes at a precarious time for small businesses. Over the past few years, they've battled and emerged from a pandemic that permanently forced many small businesses to close their doors. Yet at this moment, small employers are the least optimistic about their future business conditions than they have been in almost 50 years. And how can you blame them? 8.3% annual inflation is ripping through the economy without signs of stopping. Every business you talk to can't find people to hire, and supply chains are still in turmoil. There is no doubt that this administration's fiscal policies have played a hand in overstimulating the economy. The San Francisco Fed found their fiscal support accounted for over a third of the recent rise in inflation. Unfortunately, this administration's response has been much of the same rhetoric. The president tweeted that the key to bringing down inflation was, quote, making sure that the wealthiest corporations pay their fair share, end quote. And yet his new press secretary couldn't even defend that statement. In an environment that leaves business owners looking for ways to cut costs, this president still has on his mind increasing taxes. That would be devastating for small businesses. On this committee, we've established that tax increases would directly and indirectly impact small employers. But lucky for us, the key to a thriving small business economy and a lower inflation environment lies with less government interference and spending. And let's be clear, we are nowhere near finished with the oversight of COVID relief. The Washington Post just put out a story that about close to $163 billion in unemployment fraud. And combine that with a staggering amount of fraud in small business programs, we're nearly $250 billion in waste. Imagine what we could do with that money. Maybe we could actually deal with the rapidly approaching expiration dates of Medicare and Social Security trust funds. The message to the American people should be clear. The federal government will not spend any new money while we work to get back the billions of dollars in improper payments. Mr. Kelly, I have just a couple of questions. Is the SBA and the Office of Capital Access expecting or planning for a recession in the U.S. economy?
We are not expecting anything related to that. What we are doing every single day is providing credit not available elsewhere. So
so you are not. You are taking no steps at all to plan for a recession.
Our program, with respect to its core products, is actually a product that will work very well for small businesses and lenders, regardless of the economic.
Oh, that's wonderful. So, but are you saying that you are not taking any steps to prepare for a recession?
No, I'm saying that we have loan products that we administer.
So you are taking steps to prepare for a recession.
I think I've answered the question, which is I'm saying.
Let's say yes or no. Are you not, or you are?
We are administering a program that provides loan products.
So is it a yes or a no?
That we're providing loan products? It's a yes.
That you are preparing or not preparing for a recession?
We are not currently preparing for a recession, no.
Okay. So would you agree that the overall economic situation does impact lending cycles and whether small business owners may seek out SBA loans versus a private lender?
I'm sorry, could you repeat the question?
Would you agree that the overall economic situation impacts lending cycles
Yes.
and whether or not small business owners can seek out SBA loans versus a private lender?
Yes, but what happens in a recessionary environment is that the SBA loan products are actually in greater demand. And so.
Okay, so good to know. So I'm sure you are aware, many financial institutions are starting to anticipate and price in a higher risk of a recession. So I'm interested in why private lenders are adjusting to this economy at a higher risk of a recession, but the SBA is not thinking about it.
It's not that we are not thinking about it. Our core products depend on those lending intermediaries that you just referenced, and the core product actually benefits them in the counter-cyclical environment. So what I'm saying to you is that the particular program that I administer has loan products that are most useful in counter-cyclical environments. So whether I am in a recession.
I've got to yield back my time because I've got 17 more seconds. As you talk with small business owners, I'm curious, what is a bigger concern for them, climate change or inflation?
I think that anything that impacts their business is a concern, and both of those.
But you think they are more concerned with climate change right now or inflation?
I think with respect to the references to climate change within the specific budget, it's in reference to natural disasters that have eviscerated their small business. So I believe.
Okay, I yield back my time. Thank you very much.
Time has expired. Time has expired. Thank you, Mr. Kelly, for appearing before us today. The work that you and your staff do is fundamental to the success of our Main Street communities. We are committed to working together to enhance OCA's program, remove barriers to accessing capital, and support entrepreneurs as they continue to lead our recovery. Without objection, members have 5 legislative days to submit statement and supporting materials for the record. And if there's no further business to come before the committee, without objection, we are adjourned. Thank you.